The FOMC has been described by some people as the Federal Open Mouth Committee. Well, the latest salvo has come from the St. Louis Fed President, James Bullard. He said, and I'm quoting most of it, policy rate isn't yet restrictive enough, and using the Taylor rule, the proper zone for the Fed rate could be 5% to 7%. Now, even 5.5% or a 6% Fed funds rate is not discounted by the market. At the moment, the market appears to have penciled in a 5% peak rate. So if you go by the CME Fed Watch tool. To analyze the current state of US bond markets and whether we can be in for some nasty shocks, I have with me Stephen Major. He is the global head of fixed income research at HSBC. Stephen, thank you very much indeed for joining us. Well, I read out the latest salvo. What do you make of this? I mean, according to Bullard, 5% is the lower bound. Do you really think there is a good chance of even a 5.5 or 6 peak rate?
I think that your opening comments were spot on, because in many ways the Fed is well served by feeding that hawkish narrative into the market. They want everybody to take this and go away and believe that they're going to go to at least 5% and stay there for 1 year or 2 years, something like that. The problem is, in the bond market, we can be quite mischievous and we sometimes question what we're told. So I take it with a pinch of salt.
Okay. What is your own estimate of how the Fed might move? Are you expecting that there is some chance at least of a 75 in December? You know, overnight after this Bullard statement, the CME Fed Watch tool has increased the chances of a 75 basis by 5 percentage points. I mean, it was standing, I think, 14.5. Now there is a 19.5%. But of course, the majority is expecting 50.
Yeah, so the Fed funds target rate is in a range of 3.75 to 4 today, and as you've correctly said, the futures market is set up to go close to 5%, and that's slightly above where we were in the September dot plot. We'll get something else in December. Probably validates a peak close to 5. I'm just going to say within 1/8 to 1/4 around 5. But when you value a Treasury security, this is only one of the variables. We also need to know the longer run equilibrium. Where are we going to be in 3 to 5 years' time? And I don't think that number has changed much from the last cycle. It might even be lower. So imagine that in a couple of years' time, rates are going down and they're heading down to 2.5. Now, if that was the case, then the expected value on the 10-year Treasury wouldn't be what it is today, which is close to 3.8. It would be closer to 3.0. That would be the correct number. If Mr. Bullard and his colleagues had their way and we got to 5% or above and we stayed there forever, then the 10-year security should yield at least 5%. Yes. I get that. But that's only a scenario. And you also have to wait another scenario that things might not be so good and that we might have to go back down towards zero very quickly. In that case, the yield could be as low as between 1% and 2%.
No, I read your blog and your newsletter making a convincing case that it's a good time to buy US bonds. As you say, people don't want to know why, they want to know when to buy. But isn't there a good chance that if the data came in strong, the 10-year could still go above 4%? And therefore, the chances of buying it even cheaper are very much there.
Yeah. Well, yes, I think that one of the recent papers was about the time value of money concept. It's intuitively quite appealing if you've got the possibility of getting 5% in cash and short-dated securities, say for 6-month deposits. It's quite attractive just to wait. I mean, as you're suggesting, maybe the yield could go higher. We should just wait. But the danger with that is when it turns, it will turn fast, and we will wish that we bought bonds. So we cannot ever predict exactly the date and the rate for the turning point. I think it's fair to say that the fourth quarter of 2022 has already seen probably a peak in the dollar. Probably a peak in the real yields. Real yields were close to 2% recently, double the last cycle. I think maybe a peak in some of the geopolitical uncertainty. Let's hope so, at least. And maybe once we get into 2023, we can look back and identify that the peak was being formed around now.
Okay. No, fair point. I mean, what we were on, November 1st week at 4.2, 4.3% on the 10-year. So I take your point that, we may miss the bus very, very quickly. Already 50 bips missed. But what's your view on how the Fed funds rate moves in 2023? Are you penciling in a cut? And how do you see the trajectory of the 10-year bond itself over 2023-24?
Well, we have an official forecast of 2.0 for the 10-year Treasury at the end of next year. Don't beat me up if I'm wrong. But again, that number hasn't changed for a long time. It's a forecast. It's a point estimate. If the range of possible outcomes was between 1.0 and 5.0, I imagine if I get somewhere in the middle there, if 3% is in the middle, if we're below 3%, then I think it will be a success. Now, for me, it's about probabilities. I think that the base case is they hike to somewhere around 5, stay there through the year, and maybe it takes a bit longer. But there's a growing possibility of a recession, and therefore a tip in the balance. And the probabilities of recession and the first rate cut are rising. If the markets today start to discount one small 25 basis point rate cut at the end of next year, it's actually the equivalent of a 25% probability of 100 basis points. And they're not going to do a small cut and then just stop. Markets will imply a lot more and very quickly. So again, we have to be careful of this missing the bus or the train, whatever the saying is here.
Okay, I get your point, but this is the global interest rate, the world's most important rate, and if that's going sub 3, even towards 2%, that has implications for all economies, including ours. So that's an important takeaway from this conversation. What about the US dollar itself? Do you therefore think that the 112s and the 114s are behind us? We don't get there? Or is that still a possibility?
Yeah. No, we think the peak has been reached, and it may have been a couple of weeks ago. I think the peak for real yields was about four weeks ago. The peak for the dollar maybe about 2 weeks ago. There's a great deal of resistance to a strong dollar coming from Japan, and you could even say China. It looks to me that we've got to very wide spreads in interest rate differentials. So there's a level where the dollar starts to fall over, and I think that we reached that already. So we can look into 2023 with the dollar correcting somewhat. Now that makes it a very different backdrop for emerging markets in general, because we all know that through periods of a strong dollar, it can be disruptive to some economies more than others. So if we can change that paradigm, and I think that that's most likely now, then it does open the door, I think, to some degree for emerging markets.
That's what I was working towards. I mean, if you are arguing that the dollar's past its peak, then it ties in with some of the people who believe that even the rupee may be past its bottom for now. It had touched 83 with the dollar, and at that time we had forecasts of 84 and 85 as well. Now, if the Indian currency has bottomed out, does that make Indian bonds attractive? We haven't seen too much of foreign flows into Indian bonds. Do you think now would be a good time, or we could see it eventually happening very soon?
Yeah, I can only say that from an outsider's point of view, Indian yields do look high. And in emerging markets, amongst the high yielders, we're talking about comparisons here with Brazil and South Africa, in the region, Indonesia. So the comparisons become interesting. And the dollar is only one input to the analysis and the investment conclusion here. I think the door becomes open when other emerging market economies become less attractive. We've already seen Russia, for example, move out of the indices for bonds, and China has some challenges as well right now. So these are opportunities. The question is whether the local fundamentals can confirm that the value is there, and that I'm going to leave to my local counterparts to explain to you. But it seems to me the possibility is there.
Okay. Yeah, we do have Hitendra off and on the channel. Thank you very much for that. As well, I take your point that there are other inputs. I mean, our own fiscal deficit is there, and then there is the crude price, which is a very big import item. So we perhaps have to have a bigger bond discussion on India. The more important question I want to ask you is whether we are past any financial accidents. When the UK gilt problem was on the boil in October, it very much looked like there could be accidents. People were even talking about Lehman very freely when some of the pension funds were in trouble. Do you think we are past the period of financial accidents?
Well, the Fed and other central banks will respond if there is something serious. At the moment, I would say the analogy is like the Fed maybe could hear the ambulance coming, but it couldn't see the ambulance from the accident. So in a way, they need to see much more closely. And I think the UK, everyone could hear the ambulance, but in the end, it's kind of come and gone, because the UK has now gone back onto the same path as before. Yes. So accidents will happen, especially in an over-levered economy. There is just too much debt globally. So when rates go up, the impact can be outsized compared with the past.
Okay. Well, point taken. It was a pleasure speaking with you, Stephen Major. Thank you very much indeed for joining us and giving us a perspective of the US bond market. It's an important market for all of us. Thanks a lot. Okay, so that's the key takeaway. I mean, I think it's a very big takeaway that, next year, same time, we could be looking at the US 10-year at 2% or perhaps somewhere between 2 and 3%. That makes a very big difference to how we would look at our own rates and how the RBI may be thinking of its own rate hikes. On that note, we wrap up on Bazaar trading ideas on Chartbusters are lined up.